Hello, everybody. My guest today is Jason Weingarten. He's the co-founder and CEO of Yello, a talent acquisition software company to simplify the hiring process. His vision for reinventing the way companies acquire talent has helped Yello grow an impressive client roster. The software powers recruitment initiatives for the world's largest brands, including 110 of the Fortune 500. Jason, you ready to take us to the top?
Let's do it.
Okay, so are you hyper-focused on kind of Fortune 500? As you know, this is a very fragmented space, and I'm curious if you've gained ground because of that focus.
We're hyper-focused on helping recruiting teams love their work. That is first and foremost what we do. And what we've found is that the recruiting teams at the enterprise don't necessarily have the tool sets that they need to be truly successful. And so that's where life has taken us.
There are two kind of models though behind this. One is that, hey, we need a critical hire. That's the CIO, that's ex-Google, but also worked in oil and gas in Dallas. And then there's the other version of that, which is McDonald's is a Fortune 500 brand. Their turnover is really high. And then they're hiring, 100,000 people a year. Which kind of sector are you serving more?
So that's why it goes back to the recruiting teams. It's not an individual executive recruiter that's just doing like a single big fill. Obviously, those are critical, and we use them here at Yello. But we help the large recruiting teams make sure that they are more strategic and less tactical.
More strategic and less tactical. Okay, got it. Walk me through kind of how you price the product, right? So is this a pure play SaaS company, or do you have any kind of 30% of first year pay kind of thing?
So it is a SaaS play, and we model based off of usage. We define usage as the products that they're utilizing on our platform, the regions in which they're utilizing it, and different segments, like if they're using it for campus recruiting versus lateral hires. Okay,
campus versus lateral. Interesting. Now, do you do any, you said you have upsells based on features, regions. I assume there's some kind of upsell based off just volume of hires through the platform. Is that accurate?
Usage, correct.
Oh, that's what you define usage as. Okay. Uh-huh. Well, what if so usage can be a bunch of different things depending on where you put it in the funnel. Is it number of kind of intros you send them, or actual number of hired? Where do you put the level?
So usage is often typically by volume and complexity of that volume. So, for instance, if it's about a company that needs to have 10,000 hires that year, obviously that's going to be significant volume. It may be 100 hires, but they're going through 5,000 interviews. So we take a look and we see where's the place that we can make, where we can provide the greatest level of efficiency, and we really focus on efficiency.
Interesting. Because the episode is short, we won't go down every customer cohort, but on average, what would you say kind of a sweet spot is for you in terms of what a company might pay you per year for the tech?
So it really depends. And I know that's probably not the greatest answer in the world, but we have companies that pay us in the tens of thousands, in the hundreds of thousands, in the seven figures.
Yep.
So it really, again, it goes back to that usage and how we can ensure that their team is most efficient.
But you can look at your total customer base, look at the total hires or intros you send them per year, divide and kind of get an average. I mean, are we talking 100 a year or 100,000 a year?
I'm sorry, what the average ARR?
No, sorry. In terms of like intros, right? Like I'm trying to get a sense of if it's 100 per year or 100,000 per year or $1 million per year.
So, and again, that it kind of depends on the customer base. But if I were to segment it, we have some of our large enterprise that will look at doing thousands of interviews a year. We have one customer that did over 100,000 interviews.
Okay.
And so it's not necessarily the intro itself, because the recruiters will get that themselves through recruitment marketing and other focuses. But it could be specific interviews. It could be specific events they attend. It could be campaigns that they send. So it really, we like to sell to the enterprise in the way in which they want to buy.
Yep.
And it's usually based off of what problem we're trying to solve.
Let me ask this differently. We have a lot of people listening right now that are growing their teams very, very fast. What is too small for you? What should, are they talking they should be doing 100 interviews per year and spending $100,000 on recruiting kind of software? What's the minimum for you?
So we typically look at what we'll call large enterprise as our sweet spot customer, but we have customers that have as few as 1,500 employees that are utilizing the software, and they're probably replenishing or growing it, call it 10% from a headcount standpoint.
And cost-wise, that'd be like a $10,000 ACV kind of thing?
No, we're a premium product. So, I mean, we don't typically work that way. So I'd consider ourselves more of a Four Seasons type product of we're really focused on efficiency.
Wait, so Jason, so what's the number? This will save us a ton of time. We're like dancing right now. Are we talking like $100,000 minimum spend on recruiting kind of tools or what?
No, again, that depends, and we don't disclose the exact pricing, but depending on the size and scale, we see customers that are, call it a 50K in that range.
Okay.
We also see some that started seven figures. It really depends, and that's why if I give you an average number, it's not going to help.
No, I'm not. I'm asking for a specific story, and you're staying really, really vague. I'm trying to drill down on one cohort, and we're still staying vague. So that's what I'm trying to do, is drill down on one very specific use case. So what I just heard you say is there is a use case around a $50,000 ACV where a team might be about 1,000 or 1,500 people, and they're replenishing 10 to 20% of that, or growing 10 to 20% of that every year. Is that kind of a good back of the napkin metric there?
It depends, but I think.
Let's move on. So let's put this on a timeline. When did you launch the company? What year?
Launched it 10 years ago. Actually, 11 now. 2008.
That's a hell of a year to launch a company, Jason. What were you thinking?
That was the best time. You launch when there's pain, especially in the recruiting space. Yeah, we got funding in August of 2008, and then Lehman hit just 6 to 8 weeks later.
Holy cow! Hold on, we have to dive on that. How much did you raise? But right before Lehman,
we did a $1 million seed round.
Okay, and total today you're at what, 40 or something?
Around there, yeah.
Okay, so $1 million right before Lehman. No, the investors, had they already wired the money when Lehman collapsed? Like, did they try and say, "Hey, I know we signed, but we can't wire this. That everything's crashing"?
So here's the fun fact. My previous company, we had sold just a few months prior, and we did really well for. It was Fred DeLuca, who was the founder and owner of Subway. So that was the only investor there, did very well for him. He said to my co-founder, Dan, and I, "What are we doing next?" We said, "We got this other idea." And no business plan, nothing. He just, he wired us the money. That's funny. Okay, good. So you had the money, then it crashed. Then what? What happened? Then it was, instead of building software for specific customers where that can go wrong, we built it based off what we thought and knew to be true in the space. And it gave us, I didn't realize this at the time, obviously, like you're selling recruiting software in the middle of companies not recruiting.
Cutting, yeah.
Yeah, it's different, but it gave us, you've heard me say the word efficiency a number of times. It gave us the ability to work with some of these big brands that were still hiring. And we didn't have competition because no one was crazy enough or funded to be able to go after that segment. So I think it gave us a 3 or 4 year runway that we've then utilized to create scale. Interesting. You mentioned in the bio you gave me, I think 110 of the Fortune 500, but how many logos or how many brands are you working with today total? We're working with several hundred companies now. Okay. And one of the companies is a large RPO, and they work with several hundred themselves. So we're probably about 600 total large organizations that are utilizing our software. Yep. And why is this space, specifically the space you're in, so fragmented? I mean, gut or instincts would tell you that there would be consolidation, there would be roll-up. But I mean, I've interviewed probably 15 people in this space. Why is there all with more than maybe 10 million bucks in ARR, right? Why is it so fragmented? I think if you ask me that question in 3 months, it'll be a very different answer. Who are you acquiring right now? More opportunities to buy organizations in probably the last 3 months than I've seen in the last 5 years. And we're bigger, so I mean, that's part of it. But there is a lot for sale right now. And it's exciting as a company that we've been able to establish our own space there. So going back to the original question of why do I feel that is, there are lots of point solutions that you can get to 3 million of ARR, 5 million of ARR, 10 million of ARR. But then you grow 1 year from 10 million to 11, and then all of a sudden funding runs out. And so getting to that next level, I think, takes a specific type of culture. It takes a specific type of long-term investor. And it takes, to me, a vision that is not just by the founder, but by a lot of really smart people. Yep. And so we've seen a lot of companies, not just in the recruiting space, but in, call it overall enterprise SaaS, try to get to 10 to 25, and that's where a lot have fallen short.
Are you guys are past 25 at this point?
We are.
Is your next big target like the 50-ish range?
Yes.
How do you, the reason I ask that is because if you've raised 46, I mean, you gain significant, I've just sensed, it's a back of the napkin thing, but I've sensed founders typically gain a ton of leverage once their ARR to funding ratio is about 1-to-1. They tend to then go out and potentially raise additional capital at that point, or just keep accelerating revenue past the total amount they've raised. Let's say you find something that you really want to buy, but you need more cash. How would you choose to fund that? Would you do it and just raise another round of funding internally yourself, or do venture debt, or what?
That's a great question. So we have a decent cap table right now. So it depends on the size. If it's a deal under 10 to 15 million, that's probably something we wouldn't go and bring another group to the table. If it's a larger acquisition and something we view to be extremely strategic, not just a product or a team, then we leverage the expertise of our board, who've been there and done this many of times, to figure out what's best based off of the conditions at the time. Right now, there are more opportunities than ever before, whether it's private equity, internal, venture debt, just using credit line. Yep. So there's a lot of opportunity right now that I don't believe existed our last tiny acquisition 7 or 8 years ago.
Yep. Look, there's also big companies like Vista Equity that just raised, $14 billion. They've got to figure out how to deploy the capital. You're potentially an interesting target for them, right? They're paying 6, 7, 8x on average. Would you go still do a Vista?
I think we would look at any private equity firm. Vista's got a nice position on iSIMs in the ATS space, yep. And they've obviously they value recruiting, so we'd want someone who's looking at recruiting and understands it. But yeah, and K1 just did a big deal earlier this week with a bunch of smaller players. But I wouldn't turn anyone down that's looking to help us grow.
Yeah, it's funny. Colin comes on the podcast and I go, Colin, are you in any talks right now to sell to Vista? And he looked at me, no, Nathan, no, we enjoy staying private. Okay, I then refresh TechCrunch, give me 3 months later, right? Because this was recently, and it's like Vista, goes into iSIMs. I'm like, Colin, come on, man, you couldn't give me the breaking story here. But look, Vista's playbook is buy the hub, or sometimes buy the spokes and then buy the hub. And this is a very interesting play with you and iSIMs together. Colin built that thing bootstrapped to basically 120, 130 in ARR. It was a really impressive story. So good. Okay, this is helpful to understand how you're thinking about M&A.
How are we?
Huh? How are you? What?
Back to you.
No, go ahead. How are you? How are you guys? What?
Oh, I thought you said, how am I thinking about M&A?
No, I said, I love how you're thinking. That was helpful to understand how you're thinking about M&A. Yeah. Tell me a little bit more about growth rate. So if you're, north 25 today, where were you about a year ago?
So we've been growing very steadily. We don't disclose specific growth rate, but I think it's better told through headcount to show how we're investing. And so a year ago, we were at 150 employees. Today, we're at 209. We still have almost 40% of the business is in product and engineering. So we still believe heavily that there are additional products and additional enhancements to our products that will create additional addressable market. We're still growing in what I would consider the hyper growth phase.
By the way, I would put that above 50% year over year at your scale. Is that fair to say you're above between 50 and 100?
And we don't disclose that specifically, but from we did hire 93 people last year.
But Jason, my audience is smart. You know what they hear when they hear you hired 93 people? They say, well, yeah, he raised a bunch of money and now he's just burning more cash. That doesn't mean growth was there.
I appreciate your audience, and we don't disclose specific growth rates, but we do. We've hired very methodically, and our investor base isn't one that's just going to sit there and throw money at people if they don't feel the opportunities.
Yeah, but it happens all the time. Eero, you just saw today taken out yesterday by Amazon. They'd raised $100 million. He came on the show and basically said the same thing. Yeah, we've tripled headcount. We're growing really fast. Well, no. Revenue was not growing like it should have been growing at a venture-backed company, and obviously didn't end up working out so well for really any common holders. Let me maybe ask this differently, where you feel like you don't have to give up any sensitive information. Over the next 12 months, what would you like to see growth rate be? You don't know what it's going to be, but what would make you really happy to see growth rate wise?
we would always want to stay above. We would want to stay somewhere between in the 25 to 50% range.
Okay, fair enough. Fair enough.
It's a good group for us. I'd be disappointed if we got into one of the traps where we're not growing strategically.
Yeah.
One of the other things that we do consider here is rule of 40 or rule of 50. And so we're thinking about it that way as well.
And just to be clear, because some people measure this a little bit differently, rule of 40 or rule of 50 is essentially taking EBITDA, free cash flow plus growth and making sure that that's above 40%.
Correct.
Yeah, that's great. And by the way, also, I shouldn't hit you so hard here because we have no idea in terms of AR what you're at. I mean, if you're at 40, right, you said between 25 and 50, but if you're at 40 right now, going 100% year over year is really challenging. 25 to 50% is still what maybe hyper growth for that level. So all good there. Now, where do you think most of the growth is going to come from? Expanding current logos or adding new cohorts altogether?
Expanding current logos.
Really interesting. Okay, so are you going to go? I mean, do you do this through buying a company and then upselling that product across your base? And
sorry, I misspoke there. To me, it's expanding with the same type of product to new logos.
New logos, okay.
Yeah, we still when JMI invested us, they looked at their cohort of companies, and everyone's got like an X factor. Our X factor was net retention. So that is something that we are able to grow the base because they're able to see value. We're able to save them money. They're then upsold additional products based off of their request and their usage, and we'll continue to grow that way. But we do believe it's going to be primarily through new logo expansion.
I mean, I would say to really have net revenue retention where it is a key kind of differentiator where you have hit on something that's really special. I mean, you got to be talking like 140, 150-ish% annually. Is that kind of what you're seeing?
When JMI invested, we were near there.
Okay. Yeah, that makes, so just to be clear, that's your expansion revenue from the same cohort a year ago more than outgrew any churned revenue by a function of 40 or 50%.
Closer on the bottom side of that, but yes.
Okay, no, but I mean that's impressive. Now, have you built the internal sales team that's incentivized to drive expansion? Like, do you give your customer support people commission, for example?
So we have a CSM team that is in charge of retention, not of what I'd call meaningful upsells.
Okay.
We have a sales team that's very experienced that will, if there are new opportunities and new products or new expansion opportunities, they are incentivized to help our clients achieve those goals.
Last question here on just how aggressive you're being right now. So, what is it? I mean, you can I'm curious, either fully weighted CAC, or if you don't want to talk about that per kind of customer, what are you willing to spend right now to get a new dollar of ARR?
So we're Chicago based, and so for us, we might be a little bit less aggressive, but we still are really comfortable with anything. We like to stay close to $1.
Okay, dollar in, dollar out, 12-month payback.
In first year.
Yeah.
But for us, we have opportunities to be more aggressive. It's more of a that versus growth rate. So
yeah, is the board going, listen, Jason, just push to like $1.20 or $1.30. We can go up to 18-month payback and still be fine.
They in certain cases they'd like us to see us to be more aggressive in sales, and in certain cases they're probably right. But we also want to make sure like our marketing team's hitting the right vein, and
of course,
and we're not. The last thing I want is where we're not getting enough leads in based off the number of salespeople to make sure that the salespeople can be successful. So
let's wrap up here with the famous 5. Number 1, what's your favorite business book?
Ooh, that changes every day. My one right now, wow, that's a great one, is I'll go with Culture Code.
Yep, that's a good one. Number 2, is there a CEO you're following or studying right now?
Yes. I would say the main CEO I'm looking right now is I like everything that Aaron's doing at Pluralsight.
Number 3, what's your favorite online tool for building the company?
Online tool for building a company? It's got to be Gmail, right?
Hey, if that's your go-to. All right, number 4, how many hours of sleep do you get every night?
I just read a full study on that you need over 8 hours, and unfortunately, I'm right around 6.
Okay, well, that can be approved upon, right? All right, last question here. What's your situation? Married, single, kiddos?
I am divorced, 2 kids, 11 and 8, Gigi and Dylan,
Aw.
and they're both amazing.
And how old are you, Jason?
41.
All right, take us home. What do you wish your 20-year-old self knew?
Um, a lot. I would. The one key thing is that life is neither as good as great or horrible as you think it might be at that time, and things tend to work out if you stay focused.
Guys, it's never as good or bad as you think. Coming from Jason, founded Yello, again, making recruiting teams more efficient, working with over 600 customers right now, north of 25 million bucks in ARR, growing. He wants to be growing kind of 25 to 50% year over year. $46 million raised, 209 people, net revenue retention north of 100%. Back when JMI invested, it was call it north of maybe 140, 130%. Right now, he's being conservative, called $1 in to get a new dollar out in terms of ARR for a 12-month payback period, but that might change as they look to scale. Jason, thank you for taking us to the top.
Appreciate it. Thanks for your time.